Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlatnik. Today it is my pleasure and a privilege to welcome Lane Kawaoka. Hi, Lane.
Hey, Mike. How's it going? Aloha, everybody.
Yeah, aloha. That's how you say it in Hawaii, right?
That's correct. That's correct.
And you hail from Hawaii. How long have you been living in Hawaii?
I grew up here, but I was in Seattle for maybe about a dozen years. But as the saying goes, live where you want, invest where the numbers make sense. So I like to be warm. Although I like where you guys are out there in New York. We've actually got a couple hotels out there now, but yeah, I like the warm weather out here for sure.
You certainly have a better climate than here in New York, although we have all four seasons, but you certainly enjoy Hawaiian paradise. So, Lane, I guess you're a founder of a few great websites, fund, aloha.com, simplepassivecashflow.com, REI Aloha, and you, I guess, own or control, forgive me, I'm saying this, you know more than I do, over 10,000 units across various markets. So before we dive into real estate, couple of words about you. Obviously live in Hawaii, family, anything about you and your family you want to say?
Yeah, I got a 2-year-old now, so that's probably why I haven't been making it out to some of the circuits, especially in the pandemic. But yeah, life changed a little bit recently. But now I realize not a lot of investors get started actively when their kids are young and born, and until the kids get to be about 8 to 10 years old. At least what I see with my investors, it's kind of like a no man's land for doing anything when the kids are young like that, right?
Yeah, makes sense. Listen, when you have small kids, it's a lot of attention. So it's either you're going to be doing it or your significant other. And if you want your kids to get good education, good life, good parenting, you have to be there for them. So, all right. So let's jump into real estate. So what's hot out there today? Is kind of multifamily sector, it's been beaten up a little bit. It's been a number of concerns with interest rates having risen up, and some of the challenges managing post-pandemic. The Class C properties have been more difficult to manage than most folks thought. So you're seeing opportunities shifting from Class C into something better like Class B. What have you been up to? Kind of just curious.
Yeah. I mean,
where are you seeing the opportunities?
I think like with a lot of operators, we got started with a lot of Class C assets because that's all the brokers would give us access to, right? Luckily, we sold a lot of that prior to 2021 when there was a nice selling cycle there. Part of the reason why is, a lot of those Class C assets, they're smaller. You can't really support a property manager there, and then, extra handyman staff to knock out other third-party punch lists like plumbing and HVAC. So a lot of those properties, I mean, it wasn't uncommon to be in like the 20% delinquency. So economic vacancy of, or economic occupancy of 80% coming in. Still profitable, not from a cash flow basis, but from, value add, severely taking those kind of distressed properties and bumping it up. But a lot of the assets that we went into, after 2019, we kind of stepped up to our thought. We are trying to get to more B class, a little bit better clientele. But, going through the pandemic and then eviction moratoriums, and you start to realize there's not much difference between tenants who have $50 in their savings account or no savings account at all to those who have $500, $1,000. It's still one bad thing happening from just being out on the streets, right? So, I mean, probably a lot of investors listening on this, they've kind of heard the narrative, right? The pandemic happened, and then eviction moratorium started to happen, and then a little bit of staying put, and then off to the races in terms of rents. But right now, rents are a bit stagnant, right?
Yeah, rent growth has slowed down for sure in many markets. Of course, it's different market by market. Things are different. Why are rent growth have stagnated? Is there extra supply of product being brought to the market? Just curious, uh, what's happening out there? There were a lot of housing starts a few years ago, including sort of in the post-pandemic era, and some of the product must be coming to the market right now.
Yeah, and I've got a couple theories and ideas, and one of them is this is a bit of like kind of a train hit slack coming out of the system post pandemic, right? Because like 2021 was just a phenomenal year of rents going up. Like in Phoenix, where we operate, I think you had like 10, some depends on where you got your data. There are like 10-20% rent increases per year, where normally you want to underwrite maybe 3% for a hot market like Phoenix. And now I think it might even be a little bit negative at this point. But that in that very up and down market, maybe you can call Las Vegas very similar to in a similar market where it gets really hot and cold. Certainly there's a bounce back effect. But my second theory is kind of what you were alluding to there. Across all markets, you have general supply that's coming online that's a little bit more than what the needs are normally. But it's not like, people need to understand that there's always thousands of units coming online in a certain MSA, even maybe 10,000 units coming online. It's always like a fresh blood supply, if you think about it, because the housing stock is always kind of getting older and older and older. Of course, it's hard to kind of figure out, your class D and F product. When are they exactly being bulldozed, right? What is the decay rate of that? But you always need to have fresh supply coming online. And I look at like the rent increases per year. That's kind of indicative of the supply and demand dynamic, and takes into account of what new inventory is coming online. But my whole theory on this is, if you look back 2 years ago, and the 2 year slack back is, I think, an important rule of thumb. If you look up, people can look up this data on housing starts. So housing starts, doesn't matter if it's a single family home or an apartment unit, it gets kind of monetized as a housing start. So when you're looking at these starts, you're going to see that go to market typically a couple of years later. What you're going to go through construction, and it's going to go to market and now compete with your existing housing supply there. So if you look back around 2020, if you would have started a project in early 2020, which maybe would have not been practical due to the pandemic and probably got delayed a little bit, that inventory would have been coming online 2022 in the beginning of that year. And I think what you're starting to see is the after effects of 2021 and a half. I think that's when the interest rates started to be jacked up, right? It's hard. Sometimes it's hard to remember, but the second half of that 2021 was when those interest rates really started to become a head scratcher for new builders come in. I remember because we finished one of our projects in October, and then I remember Thanksgiving kind of going back and forth with the lender and being like, whoa, what's happening here? So I certainly know Q4 2021 when this dynamic was in full effect. So basically what you're having a lot of the builders, the developers get the wind sucked out of their sails. So again, you got to apply 2 years forward. So if the brakes got hit Q4 of 2021, now you're going to start to see that supply kind of stop or drastically go down. What is that? 2023 Q4. So that's about now, right? Or that's coming up. So it kind of makes sense.
Yeah, that's a very interesting perspective, the 2 year delay. By the way, the term that I like to use on what you described, that the rents were going up a lot and double digit, and then they slow down and even turn negative. There's a wonderful term. It's kind of a fancy sounding, but it's called reversion to the mean or reversion to the average. As that's exactly what happens. When the rents outpace the historic average, at some point they have to go flatline or slightly negative at some point of time to revert to historic average, sort of per se. But back to the theory on 2-year delay, pretty interesting. Yes, we're recording this in second half of July 2023, and we go back 2 years. The interest rates just started to show signs of increase at that time, and you're right. By the late part of 2021, a lot of pain was beginning to be felt. It wasn't a complete pain because actually the rates started moving, but the Fed hasn't yet raised rates. It was kind of bonds were beginning to move ahead of the Fed, expecting the Fed to make the move. But from a new construction starts, high interest rates obviously increase the cost of construction, and developers probably were beginning to slow down. Maybe not completely stop, but at least be mindful of the environment that they were getting meaningful headwinds. So now all that supply has been coming to the market, and maybe it'll slow down because the starts in 2022 have been substantially slower, right? So we will probably see some level of slower deliveries relative to, so if it's a 2-year delay, that math makes a lot of sense. So I appreciate you sharing. So what are you doing now? Are you investing in new construction now, or you're sitting and waiting for the market to go full cycle? Because the
it's hard right now to get financing.
It's 2 years from now, right?
Yeah, it's hard to get financing, but that's kind of what we see is the opportunity, and a lot of that's like a lot of groups like ITR Economics, when they show their housing start forecasts and how it bottoms out here next year. That's the time to go to construction, so you can pop out 2 years ahead, and in a place where not a lot of new inventory is coming online. And hopefully by then, if you've kind of followed the forward curve on interest rates, maybe we're back down another point, or maybe a point and a half down in the future. And that's kind of thing where a lot of us are thinking that is the time that's going to be a very hot market, right? That culmination between moderate interest rates and this built up demand due to low supply at that point. So it's kind of like that saying where when you go through resistance, you want to push through, but that's the whole reason. It's not really, if you can push through while other people aren't surviving, then there's more kind of spoils of war at the end when you get to the finish line. But it's one of the things is getting the lending, and if you're going to have to come in with a little bit more equity, which is, I think, difficult for a lot of retail investors at this point, right? A lot of people on the street are saying, well, there's a recession coming, I need to hold on to capital. So yet again, another variable or a barrier for operators to get those LP dollars from investors, and a lot of which may have a retail investor mindset, where they're seeing what's happening in the news headlines and want to hoard cash a little bit.
Yeah, that is absolutely accurate. I concur with you. Higher debt service and the headline news or headline noise is discouraging folks to participate, or from participating in new construction. But the question, let's just compare. I like to compare this. So new construction, if you're a contrarian player, you go in when everybody's out, right? You basically start building when everybody stopped building. And that's when you can get the best deals in theory, but your cost of financing it's high. So obviously you have to raise more equity, and which is hard to do, and it's been a difficult journey. But then on the other side, on the new construction side, you can't really get a discount on the construction cost. It costs what it costs to build. So the thought process here is labor, material costs, they might slightly come down, inflation may slow down, or I don't know if it's going to reverse, but at least the slowdown in inflationary pressures. But the cost to build is still cost to build. how do you compare this to trying to get a deal maybe on a better distressed, if you don't want to go class C, go class B assets in multifamily. Try to find a distressed seller, not necessarily distressed asset, but a distressed seller where you can get a better price per door, even though it's not a new product, but it's a product that if you do right marketing, you can theoretically get a better price relative to the new construction. Because new construction, yes, it's a newer product, and it might have its own supply demand forces, but at the same time, the biggest challenge that I see with new construction today, it's really difficult to have the numbers pencil unless you're going to expect or you're going to pro forma substantial increases in prices because interest rates will cycle back down because your cost of money just gone up a lot, right? And you're building on a lower leverage because you're doing lower leverage, higher cost of money, your returns on equity just look less attractive. If you take a conservative valuation approach in the future, value of the asset. I'm just kind of thinking out loud. You tell me what are you seeing? Maybe I'm wrong. Maybe new construction can look very attractive today, but I'm not looking at the right type of opportunities.
Yeah, I mean, we kind of we're in the same conundrum, right? Because we kind of come from the world of operating the Class B and C multifamily. I'll start off with the things that we don't like now, right? I mean, we just had inflation, double-digit inflation. Some would argue that it's still here. But when you have, you're in markets like, like Dallas, for example, or Harris County in Houston, like a lot of those taxes have tripled, right? And I'm sure you guys talk a lot about the insurance, right? Insurance has tripled, maybe some places quadrupled. And then in addition to all line items on your P&L. So in terms of going into assets where you have to operate value add assets, you still have a lot of variability for those prices to go up there. And that was kind of the big selling point, I think, to investors with value add projects is you had cash flow supposedly, right, on a quarterly basis. But if these costs continue to go up, likely they will, there went a lot of your cash flow anyway. And then now, at least that's kind of looking at from the con perspective on the multifamily value add side. Going back to the development side, right, you kind of mentioned, well, you can't really ascertain your costs right away. But a lot of that is, what you can do, like you can, in a way, it's kind of mitigating or de-risking a little bit. If doing a guarantee maximum price contract, you still can't price in your materials, right? That's always not really insurable in a way, but to kind of build that contract and then at least lock it in at that point. As far as leverage goes, sure, maybe you can't get as big of a first lien note. But I guess what we'll do is sometimes is bring in a preferred equity lender to increase that leverage from that perspective. Now, there are pros and cons of doing that, of course, right? But when you're working with a non-predatory bank to come in as a pref equity, that leverage can really juice your returns there. But you couple that with bringing in extra capital in case those things you mentioned, the prices increase. So that's kind of the way that we'll play that. Additionally, with a lot of like changes that will happen in the multifamily value add side on the expenses equation, we don't really have to contend with that once we build. At that point, if those types of expenses like insurance, electricity, whatnot goes up, then we'll just sell it. So we're kind of mitigating those types of risks on that side. But I think from the big picture point of view, I mean, I'm looking at what people are buying. I see these deals float around. They're buying properties in Texas for $220,000 a unit, and I'm like, well, if you can just build that for Class A, that's 30 years newer, and doesn't have a big capex budget to begin with. That's what I'm looking at from that perspective. And again, if I can build something for the same price, people are buying 30, 40-year-old properties with a big CapEx plan, which is why they're doing the value add-on in the first place. then there's a big differential in terms of value and potential profit there.
Yeah, the build new hypothesis or build new strategy. If you can build at a cost similar to the old, of course you're better off with the new. I couldn't argue with you. The whole idea to buy old is if you can buy it at a steep discount. The cost of insurance, well, insurance is skyrocketed in many markets, right? And insurance is something that's going to be higher even for new product too. It heavily depends on the market, of course. Type of construction matters, but if a hurricane is coming through a given market, they're going to price all insurance high in that market. So insurance is a gigantic challenge for all operators everywhere, unless you are in markets that doesn't see natural disaster. Phoenix is one of these markets that sort of been, a little bit away from the, no hurricanes and no tornadoes and so on. But many other parts of the country, they see hail, they see tornadoes, they see hurricanes, they see other natural disasters. So I completely understand and agree with you that the taxes, going back to the taxes. So taxes are municipalities everywhere. They're hungry for revenues, and not much you can do. It's a perpetual battle. It's a perpetual battle. Politicians needing the dollars versus the homeowners trying to justify kind of what the asset is worth. There's always a legal battle. It's funny how here in New York City, for every building, almost every year, you hire essentially an attorney that every year you file a petition to battle the city on the assessed taxes. It becomes the norm. It's almost like it's given that the city will overassess, you battle it, you're going to get a reduction, and every year it's the lawyers make a living on this. Just that's all they do. They literally battle the city for the continuous assessments, and it's everywhere. It's New York, it's Florida, it's Texas, it's continuous battle. So anyway, let's go back to the new construction, because I'm kind of intrigued. You're right, you could lock certain costs, and certain costs will float. And the preferred equity is an interesting piece. We've used preferred equity. I certainly like the idea of preferred equity. You have to be very comfortable and confident in your execution, because you're taking on more risk with having primary debt than preferred equity relative to the common equity. That system makes sense as long as you can execute well. The construction also has another risk, and I don't know how you mitigate that risk. Delays, obviously cost overruns, and at times you've got sort of uncertainty of what the future rent will be. On one hand, you expect the rents to be at least in line where they are today, but if there's some kind of negative inflation or at least further slow down, while the insurance costs climb and taxes climb, before you know, you deliver a product and you may not be able to get the valuation you're expecting. That's kind of and there's no cash flow, right? You basically at that point just sunken in the cost to build until you can deliver the product and stabilize. And I've seen enough of the new product, depending on the market, they build it for certain rents and they can't get those rents, and then it becomes, boy, I mean, what did we just build?
Yeah, I mean, I think that's kind of where one of our competitive advantages, right? Like we started as operators, so this actually happened with our last project. We finished it last year, or 2022, end of 2022, and obviously wasn't a great time to kind of go to market. And so what we did, we just held on to it and leased it up, right? So most developers are specialized in developing. They don't want to get into the operation game, so they try to unload it as soon as possible. That's usually the best time to exit if you're in a good selling market. But if you're not, you do what we did and we lease it up, and then we kind of just hold and then lease it up and sell it at that point. At that point, it's less of a risk, right? You're not going to that lease up stage. So if you have empathy to the new buyer, they're coming in with even less risk. at that point when they're coming at 90% occupied.
Yeah, our usual arbitrage, purchase certificate of occupancy versus lease up. And in residential, in theory, that lease up time is not that long. So if you operate it well in the right market, you can get there fast.
Right.
Comparison to storage, you need 3 years to lease up or 2.5 years. Residential, if you're in a good market with good product, you could move it relatively quickly.
Yeah, and that's kind of one of my prejudices going through, the multifamily side is like the biggest variable is people, as the saying says, tenant, termites, and toilets. The tenants are a big one. And even if you have higher end tenants, they are still people and tenants with problems. And that's, going back to buying value add, sure, every deal is different, right? Don't get me wrong, right? But like if you're going after a distressed property, you got to think that that current operator has been kind of running dry on funds for several months, maybe even a year, and your occupancy and dropping, and then your tenants start to get really badly behaved at that point because things hasn't been fixed. The management doesn't care. The PM company knows that their owners are kind of going under. It's just not a good situation that I want to kind of step in as the new stepfather, basically. So that's something I'm kind of worried about. If people can kind of get a sense of some of my apprehensions with, going into a property that, yeah, you get it at a good price, but it's that price because of a reason, right? And that kind of gives me a little goosebumps, kind of just thinking about it. Of course, never say never, right? Who knows? We may do one of those, like I said, but generally speaking, you're going into something with a little bit of mold and hair on it if you're picking it up at a good price. And generally speaking, I mean, you can make money in whatever business plan you want. Typically, the more hair and mold on it, the more money you make. But that's something that we've always tried to not get into those very deep value add type of projects. We've always been buy something existing that performs pretty well or stabilize, so 90% occupied or better, so we can get those Fannie Mae Freddie Mac loans right off the bat. And part of that is we don't want to deal with these really difficult tenant kind of projects, because then now you're dealing with more of a culture issue, community issue. And but sure, yeah, if somebody out there likes to work on those types of deals, I'm sure they'll be coming out here in a bit. But boy, you got to have the stomach for that.
Yeah, Lane, I appreciate that. That's you had great wisdom in there. It's a different strokes for different folks. You prefer light lift, no heavy value add, because it is a lot of work, and we've seen this on many projects. You get a good price, but now you've got a bunch of tenants you inherited who are getting, back to the COVID discussion, who are getting COVID subsidies, or city had programs, and these programs are running out, and the tenants have stayed there without paying for a long time, and suddenly now they have to pay instead of the program paying. They don't want to do that. So as the operator, now you got to get all these people out because they are essentially, they are living for free, and then it suddenly becomes an occupancy problem. You had a great occupancy for a while, but now you've got to get them out, renovate, and lease again. And you're right, it's a lot of work. It's a game of specialization. I would say this: if you're local, if you've got construction crews, you are an operator. You're like a strong local operator, and you know your market, you know how to execute. You got leasing, property management, construction management, all that stuff you can do well. But if you're doing this from Hawaii, you're trying to operate an asset 1,000 miles away or 2,000 miles away or however long, you have no choice. If you go for a heavy lift, it's very hard to execute. So you're better off with very light lift, completed product, brand new construction, or fairly new, last couple of years at full stabilization. You take on less risk, just because it's very difficult to do it any other way. So I completely appreciate your position, and I certainly feel that it is a lower risk, a little bit more stable strategy, but you don't have as much upside if you can't create all that extra value in these assets. But again, it's a risk reward, right? Most folks don't realize that in order to generate higher return, you have to take on more risk. There are, of course, asymmetric deals where you take, you got a great deal, you're not taking that heavy risk, but you're taking still great upside if you execute. But most of the deals, higher risk, higher
The
reward
trade-off.
potential, but the reverse is true. Lower risk, lower reward, but you have to, you don't have as much headache.
Yeah. I mean, every time we've gotten burned in the past is in terms of due diligence is on things it's hard to quantify, such as tenant quality, right? Like you can go through the audits on, credit scores and, how much income, but, sometimes those things can be fabricated, right? What was the latest one? Like it used to be you look at bank statements or stuff like that, but like sometimes those can be just very fictitious, right? And you close on a property, you can't go back and do a lawsuit to the previous buyer or seller. It's just kind of throwing good money at bad money. And that's, at least from our experience, that's always been the biggest kind of non-quantifiable due diligence item, is that the tenant quality. And it's just kind of like the bad thing about the developments now, where you replace one problem with another, and the developments is it's hard to find a good 10-acre plus property to build on that's in the growing path of progress. There's just not many of them. There's quite frankly none in Phoenix because it's all infills, if anything. So we're kind of more to, like the Floridas, the Alabamas, the Texases out there for those, but you have
insurance problem.
Yeah. I mean, kind of gone are the days, I think, for us, like of doing a deal every other month. We don't really want that type of throughput anymore. So getting more, selective, or having to be more selective, right? Because we can't find 10-acre lots of properties every other month or even multiple times a year, right? It's very more rare, but that's kind of what we kind of wanted to be, as like the vision of, how active we are in the market. So the transition, I think, came at the right time.
Well, you're getting wiser, right? Most kind of wise people, they're not looking for volume. They're looking for fewer, better deals, right? At the end of the day, the volume game is the game of the past. When everything was going up, you wanted to run more and faster. And now when things are going in the wrong direction or things are slowing down, certainly need to do fewer, better deals. So what have you done this year? I'm just curious. Anything super interesting? It's been slow for us. I can tell you we've done a few deals, but way slower than before, just because we just don't want to transact just because it is a deal. We want a great deal. In this environment, if we don't find a great deal, I'd rather sit in my hands.
Yeah, I mean, we kind of pulled back our normal acquisitions 2022 summertime. So after that, we transitioned to, just doing our slow, steady diet of maybe a development deal a year. So we've been doing that. Probably like yourself, right? Utilizing your network and your connections. We've been doing some preferred equity positions, just, to get our money lent out in more of a secure position. It's not gonna, it's not breathtaking returns, of course, right? But it's kind of, getting money working that way. We actually did some deals near yourself. We've got that JFK Holiday Inn out there in Queens. If you fly over, every time you go into JFK, we've got that one out there that we did preferred equity on. But yeah, other than I feel like the tides are turning a little bit. Maybe by the end of this year, maybe we'll kind of get back out there and do a little bit more stuff. But like I said, I don't know if I want to do those more distress hairy deals. Definitely want to, not do a floating debt. Just find deals that are good fixed rate debt, so we can kind of hold. And definitely, properties that are a little bit nicer areas. So like B+ areas or better, I think is kind of what we would kind of go after. Again, being slided more towards the quality of tenant than, those heavy value add plays, I think, if we were going to go into more of those types of deals in the future. I'll give you an example of that. We've got some deals in more the inner part of Houston, right? Kind of rougher areas. And then we've got other deals out like in Conroe, Texas, the more of a suburb, kind of far out there, a lot cleaner product, a lot cleaner clientele. And those are the deals that really don't give us too much problems out there. Yeah.
Logic dictates that.
And plus they don't increase the insurance or taxes by 3 times out there in the suburbs to like how they do in the inner city, like Harris County.
Well, yeah, it's who is in charge, right? Who is, especially in some of the politically charged municipalities or cities. There's a lot of the battles going on. But I hear you. Less headache, simpler life, still decent returns, but not as exciting. And in real estate, if you can avoid the risk and avoid extra excitement, maybe that's a safe path. The one point you mentioned, and I wanted to just briefly chat on this, and we're running out of time, but I do believe that the current interest rate cycle is almost over. So floating rate debt is not. It was a big mistake a few years ago. So everyone took it because it was so low, and then it jumped. But now the reverse is true. People are afraid of the variable rate debt, when in reality, because the rates cycle back up and they're approaching the peak of the current cycle, or have already approached, whether there's going to be another quarter or not, but we're almost at the peak. At this point, I wouldn't be fearful of the variable rate debt, although of course you prefer fixed rate debt because it's a one-way street. But think about this for a second. If you get fixed rate debt, if you have prepayment penalty, you can easily refinance. That's one of the drawbacks of locking in fixed rate debt. It's both a beauty and a curse. The beauty is you have insurance policy, right? It's fixed. The curse is if the interest rates cycle back down and you try to refi and you got massive prepayment penalty, that kind of slows you down. So I just wanted to point out that on the interest rate side, if you can still get bridge debt today when the interest rates are high, you can always cycle it back down when the rates are, they like you said at the beginning of the podcast, the forward curve says in a year and a half the interest rates should come down quite a bit. And I concur with this because these interest rates today are just too high for a long-term amount of debt that's out there. So that's my view, and I'm sticking with it. The U.S. economy
I think you're exactly right. I would just like add on to that from like the mindset of an operator here. It's kind of like don't go outside in the sun unless you have a lot of sunscreen. So like in this case, sure, interest rates are going to go down, and it makes sense to do variable rate mortgages right now because everything's telling you one way. But if you, the operator, are kind of running low on reserves or sunscreen, I guess in this analogy, then you still may not want to go out there, I guess, right? And I think that's I not looking back and maybe for the next cycle to happen, you can do floating rate debt, of course, buy your rate caps, but you got to have your reserves, right? Or at least the way we do it, right? Just in case you have to float the property, right? If you have cash reserves and you can last a while, then that's your contingency plan. But if you don't have fat reserves, like I said, even if you have floating rate or the rate caps and everything tells you that the rates are going to go down, you don't have that contingency, that backup plan, right?
That's a great point. And I'll say this, my observation is that from the last couple of years, very few people set up the deals with a lot of reserves. Most of them painted the deals with very optimistic returns. And if they overraised capital, they thought that capital would be just diluting the returns. And it's a prudent conservative investing strategy to have those reserves. But a lot of people didn't do it. And the experience of the fear of the variable rate debt is from the deals that were started a couple of years ago or a year and a half ago when the rates were way lower. And the impact is that those deals are suffering. Those deals are distressed because they're running out of cash, poor reserves, like you pointed out, and the interest rates went up. And if rate cap expires, big problems. And if on top of that, they didn't budget for the tenants to be more difficult than they thought, and they have to get rid of bad tenants. They're suffering from operating underperformance, no reserves, interest rates up, all those things combined. It's a choke. But for fresh money today, if you were to buy a fresh deal, I wouldn't be fearful to get variable rate debt. Although your equity investors, for the peace of mind, it's the sunscreen effect, right? If you tell them it's not fixed rate debt, they can get nervous. But the reality is, it's a contrarian thinking. What I'm saying is that insurance policy, buying a rate cap today and variable rate debt, the rate caps are freaking too expensive for the risk reward ratio. A few years ago, they were cheap. Now it's the reverse. You're paying crazy price for something for the insurance policy you're highly unlikely to use.
Yeah.
So
I was paying
that's
like
why
50
everybody's going to
grand.
fixed rate. Yeah.
50 grand in the past. Now the same thing is like 1.5 million. I don't
Well,
know
that's
what
the
that
crazy
is.
part.
Yeah.
And you pay right now, the pendulum swung exactly the opposite way. The companies that are effectively providing that policy, they realize the demand for those rate caps is high. But the problem is the interest rates are not going to shoot up another 150 basis points from here, highly unlikely. So these rate cap policies is almost a waste of money. But that's my 2 cents. That's why everybody's going fixed rate, because at least it feels like you can't get to a worse position with that. Appreciate your time, appreciate your wisdom, appreciate your sharing. How would folks get a hold of you? Please, is there a single website or multiple website? What's the best way to reach out?
Yeah. Email lane@simplepassivecashflow.com.
Lane@simplepassivecashflow.com. Thank you kindly, and enjoy your kid. Enjoy your 2-year-old. That's the most important thing in life. Family ahead of all the business we just talked about.
Yeah. Cool. Thanks, Mike. See everybody. Bye.
Thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.